Welcome back. Time now for Investment 360. In the Cape Town studio with me is Maarten Ackerman, who is an investment strategist and also portfolio manager at Citadel. We're going to talk about global equities versus local equities. This has been a story that's been running for 2 or 3 years now. Global equities offer better value, apparently, as opposed to our way overvalued South African equities. Maarten, it's a played story now. Surely things must be equalising a bit since we last spoke, and that wasn't that long ago.
Yes, Lindsay, I think global equities are getting more expensive. It's definitely not the same value that we've seen 2008, 2009. But if you look at the earnings potential of those companies, and a lot of people are saying we're reaching new all-time highs, and that's why they're getting worried about it. But what we are saying is you need to look at what do you pay for those earnings. And even today at all-time highs, they're trading at long-term averages, so it's still fair value. So if you think about any other alternative, you don't want to be in cash, you don't want to put money in any government bond, especially in the West. You're guaranteed to make a capital loss over the next few years. The world is getting ready to shift to second gear, so to speak. It's now the first time that the US the US government economy created enough jobs. And to actually wipe the jobs that they've lost since the previous recession. It took a long time, but that's why I'm saying the world is now ready to shift to second gear. They started by reducing the tapering, and now the talks are about when will interest rates hike. But that's still an environment where global growth is likely to be 3 or 3.5%. That's a great growth environment to underpin company profitability. And if you can buy those companies at fair valuations, there's still plenty upside from these levels going forward. So we actually think that despite the fact that we're at all-time highs, we might actually be at the stage of the next strong bull market.
Gosh, it could be a structural bull market and could go on forever. Guga, what do you think of that? Another bull market phase coming up, maybe?
Well, that would be a good thing for investors. But, Maarten, so often when we talk about global equities, it's a very large package. Are there particular sectors which are seeing great performance? One sector that comes to mind is, and a relatively new one, is tech stocks.
Yeah, it's very important. We'll get back to the local story as well, because their sectors are quite important right now. But globally as well, we tend to look at different regions and also different sectors. If you just think about the different regions, the US is the biggest market, but a lot of the good news is already priced into that market. So we do think that the US is probably very close to fair value, maybe slightly above fair value. And for us, on behalf of our clients, our recommendation is to go to some of those regions and sectors where there's slightly more value still left in the market. So at this point in time, if you think about it, there's still a little bit more upside in Europe, also the UK and Japan. And a lot of that's just the earnings recovery potential from a very low base getting back to longer term trend. Also in line with the fact that all those economies are now back into a growth environment. It's very early days for countries like Europe and Japan, but that's another cylinder contributing to economic growth. It's another environment for companies to make profit. And if you think about the valuations that you pick some of those companies up in those regions, that is where we actually find better opportunities in a global space. Having said all of that, the other thing is emerging markets. Emerging markets had a terrible time in 2013. Some of the measures that we look at, emerging markets currently are trading at close to 40% discount to developed markets. It's not all emerging markets. You need to be very selective in your search for those opportunities. But we do think that at this point in time, most of the negative news in terms of emerging market growth is probably turning. It seems like China is pulling through and will maintain about 7% growth going forward for the rest of this year. So that we do think there are better opportunities in some emerging markets, especially in the Asian countries, where you can actually pick up those companies at a very handsome discount relative to a developed market company. So that's why we still think at this point in time, the place to be is probably in global equities, and that is where you'll make a proper real return over the next couple of years.
Maarten, if I can put you on the spot and say, if we look at some of the global multinationals, multiples of 16, 17, I sometimes look through our portfolio, the online system that brings up P ratios. Just as you go down, 32, 30, 40. I mean, the South African market, without doubt, is definitely in the expensive range. So if you had to look at 5 global multinationals, Yum Brands, Apple, these type of companies, what would your recommendation be, and which ones would you look at for your clients?
Again, I'm not directly involved with the stock picking. We've got a great team that's doing the stock picking on our behalf. We're more involved with the strategy and the broader asset allocation. But if we talk about the kind of names that you've mentioned, that's typically your larger cap stocks. Most of them tend to be listed again in the US. And if we bring that back to my point on the US, we do think that some of those, call it brand names, are heading towards more expensive. But that's not a reason to sell them. So typically what we'll do in our portfolio is we will look at keeping the quality names in terms of that kind of spectrum, and reduce the positions that we've got in those portfolios to those companies, and then allocate that money towards some of the other areas where we do find that there's better opportunities. So there's no reason to sell those companies, but given the fact that we've seen quite a bit of a large cap rally, now might be a time to start cutting back some of your exposure to some of those companies. You've mentioned South Africa. You're 100% right. The speaker just before me in the previous program mentioned all the negative news on South Africa. Yet if you look at the underlying fundamentals in the local market, the JSE, every time it's a new all-time high. So the JSE is telling us a very different story. And in fact, if you look at the industrial sector on its own, and you view that as a stock market on its own, it's probably the most expensive stock market in the world. So there we are saying you need to be quite cautious in terms of just having exposure to the general market, and you should rather be very selective in terms of companies and sectors in South Africa. And even in this kind of weak growth environment that we are currently experiencing, obviously that will have a longer term impact on profitability of most companies, but that's no reason to sell all your South African shares. So the fact that South Africa is, or the JSE in general, is reaching new all-time highs and valuations are quite expensive, our recommendation is to reduce exposure to the market, but then to go and look and search for those opportunities in some of the sectors that offer still great value in terms of adding value into a portfolio over time. And there are quite a few of those still left. And then if you think about the scenario that we've painted where we've got a very weak and deteriorating growth environment for South Africa that's likely to put pressure on company profitability going forward. The trade data that's quite weak, and a result of that probably potential headwinds for the currency. But on the other side of the coin, we've got a global economy that's picking up. So you've got very weak local fundamentals, but great global fundamentals. Then we sit with a lot of dual-listed companies and rand hedges, and those companies will exactly do well in that kind of environment. So it's also great to pick some of those and include them in your South African portfolio.
Right. I just have a sort of an opinion-based question, and this might be a little bit before my time, but I remember something about in 2000, anything that was a website listed, and we had a huge bubble form, and now we've got something similar in terms of everything that is a tech company is listing, and apps are listing, games are listing, this types of thing. We're selling users. Do you think that is a potential problem that's brewing on the underlying there? I mean, if we're taking money offshore and we're investing in these tech companies, Baidu and Tencent and those kind of guys, wouldn't it be a little safer to look at stuff where there is actually an underlying asset that you can sell should the company fail?
As value investors, you're right. As value investors, to get in there, you're probably right. Typical value investors avoided the tech bubble in 2000. And we're doing exactly the same right now. Taking money offshore, we definitely look for quality companies with a strong balance sheet where they can actually maintain growth potential, pay handsome dividends, and where you can buy them at a reasonable discount. So it's not that we will go into all the growth kind of companies. And yes, there's been quite a big sell-off in tech companies year to date. If you think about the Amazons and the Googles, but there it's to be selective and go and pick those companies where you do think there's a great business model. We tend to like Amazon quite a lot. It's a model of good cash flow generation, and you can buy them at a reasonable discount. You do buy an asset, so it's not just a typical startup IT company, but once again, it's to be very selective, and also to complement that with other great opportunities around the globe, and not specifically overweight or concentrate in one specific sector.
Well, thank you so much to Maarten Ackerman. He's a portfolio manager and investment strategist at Citadel, updating us today on his positive outlook on global equities. Well, that's where we leave it for Investment 360 this evening. We're heading into a short break, but we'll return with your view. That's the part of the show where you make the call, and you can dial us on 011-384-0598, or you can tweet at CNBC Africa, #YourView410. See you after the short break.